So just to share a bit of context on the session, faith-based investors account for a substantial proportion of assets under management globally. These investors, however, tend to pursue low-risk market return investments for their portfolios, with over 60% of the assets allocated to public debt and equity instruments, and only 9% to impact investing through private debt and equity instruments. This is according to a recent study by the Global Impact Investing Network. During Sankalp Africa 2020, for those of you who might have managed to join us, Intellecap began the discussion on the role of faith in financing the Sustainable Development Goals. And what emerged from the session was that the faith community is increasingly embracing the concept of impact investing, working with the private sector, with the intention to generate social and environmental impact alongside financial returns. However, key challenges, including limited investment opportunities that match the investors' values, concerns about exit options, and lack of impact investment with appropriate risk-return profile hinders the growth. In continuation to the discussion we started last year, this session seeks to explore innovative faith-based financing models, as well as impact investing strategies that have been adopted by various faith-based organizations. Further, the session will provide insights into how faith-based investing can be leveraged to mobilize other forms of capital and unearth opportunities for collaboration. So just a brief on how we will run the session. So we have structured it as a two-part masterclass or workshop format, where we have two amazing presenters, experts in faith-based investing, make their presentation on various faith investing models, then followed by a Q&A session for each speaker. So to start us off, I would like to invite Umar Mogol, who is a partner with Robert Mogol and Partners, a US-based law firm, and trustee, Gateway Global Management Limited, a non-profit global advisory devoted exclusively to the Islamic economy. Umar is passionate about responsible and impact investing and the potential of partnerships among business and investment, philanthropy, and development, and is a thought leader in Islamic finance. For nearly 20 years, Umar has advised on a variety of corporate and finance matters. Much of his work has been on behalf of ethical and responsible sponsors, investors, and business owners seeking to create positive impact. Umar's work includes structuring a variety of funds and investment vehicles, private equity, and venture capital transactions. Umar will be sharing key insights, experiences, and case studies on Islamic finance models. Over to you, Umar.
Thank you, Rachel, and welcome everybody. Good day to all of you. I appreciate you taking the time out of your busy schedules to join us, and hopefully this will be worth your while. So we're going to take a look at a few case studies and understand some of the work that's being done in designing responsible capital structures and transactions. We'll look at questions of inclusion and participation, how to connect diverse capital sources, and looking at the idea of building relationships, so moving beyond mere transactions. And finally, we'll look at a case of social finance and the transformative potential that lies within the institution or the platform of Zakat, which I'll explain when that time comes. I thought we'd begin first just by giving you a quick overview of the Sharia, and to understand the broader framework in which all of these different investments and transactions are taking place. So first and foremost, the Sharia calls for sustainable and responsible living, for empathic, caring relationships with present and future generations and the natural environment and its diverse ecosystems, good governance, and finally the idea of searching for positive social and environmental impact. All of these principles, if you will, are geared towards the higher purposes of the Sharia, which are to preserve and protect religion, life, intellect, family, and wealth in service and in worship of God. So these are kind of the broader purposes of Islamic ethics and Islamic law. So to our first case study on inclusion and participation, we'll take up the subject of a growth equity or a venture capital transaction. And so even though we're going to talk first about this idea of equity, we'll start with probably the most conspicuous principle of Islamic finance today, which is this idea of the prohibition on lending at interest. And we want to think about, is that prohibition more than a simple do not? What's the rationale there? What's the underlying ethos? And there's a basic principle that's been drawn out from this prohibition and from other rules that impact commercial transactions, which is this idea that if you're contributing capital in order to be ethically and lawfully entitled to earn a return, that is, if you're the investor, in order to be entitled to lawfully earn a return, you have to bear risk, and specifically market or asset risk. So this particular transaction involves an Islamic investor buying a minority stake in a business, in a retail business in this case. So the first kind of filter that the investor goes through is to determine that the core business is lawful, and that's usually a pretty easily answered question, given that there are few prohibitions within Islamic law as to what business one can do. There are the typical sin industries like alcohol, tobacco, pornography, and defense, along with conventional banking and insurance. The second kind of filter that we go through is to look at how the investor is going to contribute the capital. That is, the means or the structure of the investment itself, and the documentation must be responsible. And we'll get into what that means in a moment. So now, I've started with this idea of interest at lending, of riba and its prohibition, and we're talking now about a venture capital transaction. So what is the relevance, or what is the connection between the two? So from this principle that the investor must bear risk, we'll look at a couple of typical concepts in a venture capital context. The first is this idea of mandatory redemption, which is that an investor often seeks to be redeemed, that is, to have its shares bought out by the business at a certain time in the future, 5 years, 4 years, 7 years down the road. And typically that's done at a multiple of the invested capital. So if the investor put in maybe $10,000, maybe they'll say, listen, you've got to buy my interest in 5 years at $30,000 or $20,000. So that notion runs that provision, or that contract provision, would run afoul of this notion of riba and of fixed or guaranteed returns. The redemption, the buyback, has to take place at fair market value. The second major place, if you will, or term that we see this prohibition come into play is in liquidation preference, where oftentimes investors will negotiate that, if there's what I call a downside event, a bankruptcy or a winding down of the business, that the investor gets its money back before any other stockholder or shareholder sees any capital. And sometimes the investor negotiates a multiple of their original investment or of their total investment before any other investor is paid back. So what we did in this particular transaction, in these two cases, the first was to set up the buyback, the mandatory redemption, at fair market value. And that was something that was well received by the founders of the business, because they saw the investor as partnering with them, as being on equal footing, if you will, and not squeezing and not demanding something regardless of the performance or the health of the business, but rather the investor was very much tied in to the well-being. And that continued with how we address the liquidation preference concern. So here on the downside events, like a bankruptcy, for example, there is a pro rata sharing amongst all of the shareholders. On the upside, that is, let's say the business was to grow and do very well, and was to sell to another business, for instance. we set up what I call a tiered waterfall, which was this idea that the shareholders, both the investor and the management or the founders of the business, the return that they receive depends on the amount of profit, if you will, just very simply speaking. So, I think what we see with these two concepts in particular is this idea of inclusion in the business, of a commitment to its performance and its well-being, and a return that's tied to that. And the way we look at debt, particularly when I say debt, I mean interest-bearing debt, is that it places a disproportionate, or I'll say irresponsible, amount of the underlying risk on the debtor. And that unequal sharing of risk is crucial to understanding why debt is prohibited by the Sharia, why generally speaking it is so dangerous, and why it makes economies and communities very unstable and very vulnerable as compared to one that is more equity intensive. And there have been studies that demonstrate the causative role of debt to concentrations of wealth and power, as well as inequalities, and also to the crisis that we see before us with the natural environment. I think the takeaways from this are, first and foremost, that means that how we do things are not value free. So if we are investing or we are setting up a business, our goals and our outcomes that are desired must fit into this idea of what is ethical or what is responsible. But how we get there is also important, and it might be just as important, because sometimes we utilize means that undermine the outcomes that we're looking for. And so means can and should be structured and designed to reflect the interdependence of markets and communities and natural resources. The idea of riba also ties into this concept of good governance, which is that transactions and the contracts that we use, that to evidence the transaction, they're instruments of governance. They govern the exchanges of talent or wealth or risk or ideas. And so what we find between the Sharia and impact investing today is this notion of, or rather is this parallel between the revenue sharing models of impact investing today and the Sharia on the other hand. We see risk sharing rather than risk shifting. So we take up the second case study, which is how to bring different sources of capital together, and how we've been doing that with multiple and various transactions. What we'll look at is a microfinance business based in East Africa that's raising capital to further its mission, and to develop capital relationships with local, regional, and international investors. So what we've done, or what we're working to do, is to design, I should say what we've completed almost, is a platform that is very similar to a corporate bond issuance platform, where the microfinance business can tap into capital sources theoretically from all over the world, as we've utilized best practices to integrate Sharia with finance and investment. So, without getting into too many boring details, this idea of risk sharing leads us away from loans towards sales and leasing as alternatives to an interest-bearing loan. So those are kind of those are some of the basic building blocks that we use. And the Sharia, and as it manifests itself in business and trade, and particularly finance, demands proximity to the asset, and it demands visibility as well as transparency between the different parties as to what exactly they are gathering to achieve. So we set out to design a balanced instrument. And when I say balanced instrument, I mean one that meets the risk reward profiles of conventional investors and lenders that are looking to engage in an impact business or an impact investee, while at the same time fulfilling Islamic principles. And so this takes quite a bit of effort that involves patience and education, dialogue, flexibility, and as we bridge different potential business communities and different markets together. So the result is a platform that fulfills, as I mentioned, governing laws and international financial best standards, and builds bridges across markets and communities. So we're certainly looking forward to closing up and completing that financing. The third case study is this idea of moving towards relationships. And this was a transaction that we did a couple of years back here in the US with an impact investor named Mission Driven Finance out of California that invested in an outfit called Somali Refugee Services. So Mission Driven was keen on investing and contributing and assisting Somali Family Services. And so when the Somali group came back to them, they said, listen, we're happy to receive your capital, but it has to be on an Islamic basis. And so the investor was, demonstrated a real open-mindedness and a real flexibility and a desire to build that bridge. And so, engaged us to sort of sort out, to figure out how exactly that could be done. So we had a process of education and dialogue that ultimately led to creating, I think, a pretty interesting capital stack. First was this government grant that Somali Family Services had received. Second was a financing from United Way of San Diego. And third was the mission-driven investment. So these three layers, were layered onto one another. And as you can see, we've got some pretty diverse sources of capital alongside a Muslim organization that is, aiming and that operates itself on an Islamic basis. And finally, I thought we'd move from kind of the commercial realm to the social finance realm, though I think hopefully you're beginning to see that the social and the commercial are really woven together under the Sharia. And so to talk about the two of them as distinct is really problematic, and it's really difficult to separate them because they are so embedded with one another. Charity is as with many faiths, if not all, is a central tenet and expression of faith and a proof of faith as it's known within the Islamic tradition. The Muslim world has a rich history of giving and creating financial sustainability in various realms of human and non-human life, from education and healthcare to water, and so on and so forth. So there's a very broad tradition here. And I think just a couple of examples will kind of highlight the extent and the presence of trusts and endowments across the Muslim world, particularly in the pre-colonial era, but in many places that have persisted since then. So you see here at the end of the 18th century, some 20,000, and this word waqfs means endowments, that existed in the Ottoman Empire, with a total annual revenue of 1/3 of annual government revenue. And in the 19th century, you see 3/4 of arable land in today's Turkey, 1/5 of Egypt, 1/7 of Iran, 1/2 of Algeria, 1/3 of Tunisia, so on and so forth. And in India by 1997, 250,000 such endowments. And these are, these are platforms and vehicles that have a lot of commonality with Anglo-American law, and they've survived. I think for the most part intended to be in perpetuity. So you see some have existed for 500 and some more than 1,000 years now. So that's just to give you a sense of the breadth of and the extent of social finance platforms and vehicles within the Muslim world. There are forms of giving under the Sharia, under Islamic principles, that are unrestricted, and there are those that are restricted. And those of you in the world of philanthropy will know that to be the case generally. So this idea of zakat, which is this annual giving by a Muslim person who has a certain degree and amount of wealth for a period of time, and must give in charity anywhere from 2.5% and upwards of their wealth to specified categories. So zakat as well as endowments are governed by specific ethics and specific rules. So they are restricted forms of giving. And sometimes these rules are, they're set out in the Sharia, but they're enforced as a matter of private individual conscience or maybe an organizational conscience. And sometimes they're, authorized or backed by government. So in this particular case study, a major foundation reached out to us, a European-based foundation, and not a Muslim one, if you will, that had realized the scale and the potential of zakat, and wanted to harness that for some of the important and impactful work that they were doing across the world. So, our role was to advise the foundation. And again, you see this process of education and dialogue and engagement. And that education in specific is, what are the Sharia principles? How does the foundation operate? What are the on-the-ground realities of these projects? And these were refugee children-focused projects. So it's a matter of understanding, the different rules that come into play, the different customs and cultures and the goals that are present, and to sort of, wed them together and weave them together, and to design projects that would be eligible to receive zakat. So we're advising, and the foundation is learning how can they properly solicit and market for zakat funds? How are they supposed to hold zakat funds? How and when are they supposed to disperse those funds? And so, we focused on refugee children's education, in particular, with a couple of projects in different parts of Asia, in this case. And again, the focus here was on the beneficiaries, who are the refugee children and perhaps their families, as well as the activities that the recipient projects would be undertaking. So I thought, we'd close with a few reflections, if you will, that I've sort of gathered over the last 20 years of doing this work. And I think it's really helpful and important for us to ask questions, and to, research and to engage one another in these questions and in other questions. How is capital used to extract and exploit? And on the other hand, what if capital and what if the means of an investment could be used so as to include and to enable participation and to, spread wealth out a little bit more fairly? And how can capital build the relationships between investors and investees that reflect and enable empathy and collaboration and so forth? And this idea of gift, and how does gift blend with investment? How do we design, what I think, and this is perhaps a conclusion on my part, but very different models than the ones we see usually today. It seems to me that if we're looking for a financial system, an economic system that benefits more broadly, that distributes wealth with greater fairness, and that has at least as a couple of its goals, community stability and resilience, we need to look at how to build responsibility and good governance, equity and risk-sharing mechanisms, so that we can sort of achieve these various goals and objectives that we're setting out to do. Our path towards designing responsible capital, and sort of our experience, if you will, in these transactions and in these advisory mandates, as well as many others, has been to decode and understand the different preferences that exist for debt and other legal fictions, particularly in the US and Europe. And I think that's something that those who participate in these investments have to do as well. And some have already done it, some consciously, some unconsciously. But there's something that, as a system, as a collective, that needs to be done in order to generate responsible means that build greater proximity between assets and financiers. And I suppose there's a lot that we could unpack in that bullet point, which maybe we can do in the Q&A if there's interest. and a freedom from debt, particularly, and the kind of financialization that exacerbates inequalities and then destabilizes markets and communities and doesn't really understand the interdependence that does actually exist and that tries to work against that and then produces the various types of crises that we've seen over the last 20 years and exacerbates crises as well as pandemics like we have before us today. Responsible capital should be one where health and performance determine return. So it's not only financial return, but a social and a financial return. And on the financial side, health and performance should be key factors. As collaboration and inclusion and participation are conclusions from those types of responsible means, and they demonstrate a deeper commitment and broader stakeholder well-being. So that's my little bit today. If anyone ever wants to talk, happy to chat. This is my email and slide in front of you. So thank you again. And Rachel, should I stop the sharing here?
Sharing that, yes. Kindly stop sharing. Thank you very much, Umar, for that detailed presentation on Islamic finance. And before we get to the question, I still encourage the participants to post in questions. So maybe just one question from my end. So as you are presenting, what was coming out, and particularly looking at Islamic finance and the kind of SDGs that it has focused to solve. So there was the refugees and the children welfare that they are solving. There's also the MFI that you supported, so that's looking on the financial inclusion space. Have you seen Islamic finance focused on on financing key certain development challenges vis-a-vis others?
I'm sorry, can you repeat that last part just a little, the last sentence or two?
Okay, yes. Have you seen Islamic finance focused on solving specific development challenges vis-a-vis others?
Certainly. I think with the proclamation or the promulgation of the SDGs, for example, we've seen various initiatives come out of the realm of the Islamic economy towards certain goals, within those, the broader SDGs. I see far more, bridge building coming from the Islamic economy than from other economies or markets. So you'll find a number of banks, investors, and so on and so forth that, will join on to the UNPRI, for example, or some other framework. And we'll see, for example, we came across an asset manager recently that does public equities, but they use the Sharia, they use ESG filters, and then they donate 50%. The manager donates 50% of his performance fee towards certain organizations that are within development goals that the managers have defined or identified as important to them. So we see a lot of the bridge building, mostly in one direction, if you will. But we have exceptions to that, like the mission-driven case, for example, and the Zakat case study that I presented as well.
Yeah. Okay. There's a question, a few questions coming in. One participant is asking, have you seen collaborative opportunities between the various forms of faith-based finance? So a blend of, let's say, Islamic and Catholic finance coming together to solve a challenge?
I have not seen that specifically happen. I have seen organizations that do not identify themselves, explicitly as a faith-based organization. So I'll call it. I use the word to refer to something that's not impact or Islamic, just the dominant paradigm, if you will. We've certainly done transactions where there were different types of investors contributing capital to the same organization, and sometimes the entire financing is Islamic end to end, and sometimes the target is agnostic, if you will. So the capital from the Islamic investor will be structured along Sharia lines, but other investors may or may not invest on an Islamic basis. So I see non-Islamic investors doing and non-faith-based investors doing Islamic financings. along, sometimes independently because of the investee, and sometimes alongside Islamic investors. So we've seen kind of that syndication kind of happen, the gathering of other faith investors together. I haven't seen that happen myself. That's not to say it has not happened. I haven't seen that happen myself. But we see various bodies that are devoted towards, improving or enhancing the responsible or impact capital space. Gather together on an interfaith kind of basis. Yeah.
Okay, and I think the last question was whether you've seen capital, Islamic capital being blended with other forms of capital. And I think you've answered that in your presentation. So if there are no further questions for Umar, thank you very much, Umar. I'll request everyone to feel free to connect with him. He's already shared his email on the presentation, but we can post it on the chat as well. And let's keep the conversation on Islamic finance and how we can leverage this for the greater good going. So I'll move on to our second presenter. Our second presenter is Amanda Joseph. Amanda is the Director of Faith-Based Initiatives at Calvert Impact Capital, serving as a resource for faith-based investors on their impact investing journeys. She partners with faith leaders and networks to build the capacity and community of practicing faith-based impact investors. Prior to joining Calvert Impact Capital, Amanda worked at Opportunity Finance Network, a leading association of community development financial institutions committed to providing affordable, responsible capital and financial services to communities not served by mainstream finance in the United States. Amanda, over to you.
Thank you, Rachel, and thank you, Umar. It's always wonderful to hear and learn from Umar, so thank you for that wonderful teachings. And welcome, everybody. It's really an honor to be here. It's amazing what we can do in this strange time of COVID and global pandemic, where we can be in our homes. I'm dialing in from winter in Philadelphia, Pennsylvania in the US to join you all today. As I shared with Rachel when we spoke about this session, I will be speaking from a US perspective. US faith investors clearly have relationships and commitments and investments globally. But the framework that I'm using is from the United States. Hopefully there will be some good knowledge to share. And I know we could probably spend a day on at least on each of these topics, but in the Q&A, would love to hear from folks as well. So let me share my screen. I gather you can see my screen. Great. So yes. Why are we here? I think Umar really set the stage, quite beautifully. We're really here to talk about faith investors and really answering the call to be part of solutions to the global and local challenges that we're all facing today. And just to put into context, global pandemic, economic crises, and so forth. This is, there's never been a more powerful time to engage in this work. And as stewards of faith community assets, impact investing is a powerful way to align beliefs with actions, to bring opportunity to your neighbors, and to create a more just and sustainable world. So these are statistics that I think we're probably all familiar with. These again are US based, but it is clear that our economy in most of the world, and certainly in the US, is not working for the vast majority of people. We have great income disparity and wealth disparity. Increasingly, there's an awareness in the United States. A lot of this happens around racial lines as well. But we're certainly in a moment where there's more of a recognition than ever before about the great disparities that we are confronting. We also know that quality, affordable basic services are unavailable to large parts of the population, whether it be affordable housing or healthcare, access to education and cost of education. These basic services are not available in ways that they should be. We also know that the planet itself is on an unsustainable path. I don't think we need to say more about that, but increasingly there's an awareness of climate change and the crisis that we're in and the solutions that we need to come up with rapidly. We also know that government and sources are not sufficient to meet the Sustainable Development Goals. I know folks are familiar with those, but we really have to figure out new tools and new ways to bridge that gap. And the statistic that we need almost 30 times the amount of annual giving and development assistance to achieve the SDGs. And I think folks are familiar with the Sustainable Development Goals. Go back. But these are, as you'll see, I think this came up in Umar's presentation, someone asked, these are, really helpful metrics to help understand the kind of impact that investors as well as faith investors want to see and achieve with their assets. So it's clearly a time for investors, particularly faith communities and especially faith communities, to step up. The work that we're really committed to doing is challenging capital markets to move outside their comfort zone and really see the enormous untapped potential in serving new populations and new markets. And given the poll and who we saw is in the room with us this afternoon, I think we can see you all are representing the range of players in the ecosystem that we need to do this work together. So what is impact investing? And I will share, this is an image of one of Calvert Impact Capital's portfolio partners, one of our borrowers. It's Medical Credit Fund that works in sub-Saharan Africa, provide financing for healthcare. This is a woman who now owns her pharmacy in Lagos. So much of what we do really leads to the impact that our dollars have in real communities, in real lives. So I want to go over some basics. I know we throw around a lot of terms. What is impact investing? There's actually a very specific definition. Impact investments are investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. Impact investment opportunities exist in emerging and developed markets, offer a range of returns from below market rate or concessionary to market rate, depending on the goals of the investor, and exist across asset classes. But again, impact investments very explicitly exist to address these challenges that we are all confronting in our countries. So I love this spectrum, and I like to show it because I think, again, there's a lot of language out there. It continues to evolve. 15, 20 years ago, we weren't even using the term impact investing. We use socially responsible investing. But let me just go over this briefly. On the far left, we have traditional investments, where investors are looking at financial return only. Doesn't matter if the underlying investments are doing harm in the world. We don't care. We only care about the financial return. Then we move into the spectrum of what we call responsible investing. A first step, and this is important when we begin to talk about some of the faith examples, is negative screening. This is when an investor will decide not to invest in particular industries or companies based on values and principles. It could be alcohol or tobacco or prisons or military spending. It depends on the actual investor, but you are avoiding putting your funds in certain enterprises. Then we move into what we now call ESG integration, looking at investing proactively in companies and in funds that take into account environmental, social, and governance factors in their approach and in their businesses. Around governance and equity and labor practices and climate. So there are countless factors or very critical factors that go into incorporating ESG into your portfolio. And we move into impact at the space that I work in. And this can vary again from folks who want to see that measurable impact but are more looking at market rate investments to those who are fine with more concessionary rates to achieve the social and environmental goals they are committed to doing. And then finally, at the far end, some of you are in philanthropy, is impact only, where you're giving the money away and there's no return expected except the good work that you hope to achieve with your dollars. So we'll be talking about this impact investing space over here to the right. But what I also want to know is for those of you engaged in philanthropy, and which includes faith organizations, What we don't often realize, or we're realizing increasingly, is that your portfolio may be doing harm that contradicts your philanthropic and your values-driven goals. So this is why it's so important for faith institutions, especially, to really look holistically at their portfolios. I think Umar really brought up some excellent concepts around acknowledging interdependence and a lot of other shared values that when you start paying attention to your investments and portfolio manage are so critical. Again, impact investments, intentionality, investments with return expectations across asset classes, and reporting on your impact, how it's measured and reported is really critical. Quick statistics. We're always trying to size the market of faith investors. It's really difficult to do. All we know is that there are trillions and trillions of dollars that faith communities are responsible for globally. But a few quick stats. We know that in the U.S., and I'll have some organizations you can look up later. We just learned in an important study by US SIF this year that $17.1 trillion of professionally managed investments now consider ESG factors. That's up 42% over the past 2 years. We also know that globally, the impact investing market is right now sized at $715 billion, a 40% increase since 2018. These numbers are big, but of course they need to be much larger. We also know that there are reasons why the faith community hasn't fully stepped into this space, but we also know that there were some leaders in this space, and we'll get to that as well. And I know in Rachel's opening remarks talked about a study that the GIN put out that I want to direct folks to. And then this put at the bottom, impact investing is sort of new trends or ESG investing. I find that a little bit offensive. Because this is clearly more than a trend. If we're going to really solve the social and issues, the global challenges we face, this really is the way forward for all investors, but particularly investors of faith. So let's move into a little bit about Calvert Impact Capital, because in a sense, we are a case study. We are a nonprofit investment firm that for the past 25 years has been raising and deploying capital from mission-driven investors, individuals, and institutions, including faith partners from our very start, to reinvest in organizations around the world. We managed over $2 billion with 100% repayment to investors, and it's all about this impact. We've been leaders in a number of spaces, including gender lens strategy, which I know is also important in microfinance. We're doing some really interesting work around COVID relief, again, helping to get dollars into communities that have been left behind in the United States. So I welcome folks to see our website. There are a lot of really good tools there as you begin to think more about impact investing. So we really translate between communities and markets. So we exist in the center here, along with other market-facing intermediaries, creating tools and structures to move investor dollars into community-facing intermediaries across the world. We do this through our community investment note. And I bring this up because faith investors in the United States have been really critical to our work, as well as to community development finance in America, as well as overseas. They saw early on the need to align mission and values. We have faith investors who participate with us for just $20. We have and secular investors, and we have investments in our funds of tens of millions of dollars from institutional faith investors as well. We invest in communities globally. Just to give you a sense, you may be familiar with some of these organizations to address these global challenges that we discussed. We work in over 100 countries across 9 sectors. And again, we measure impact because that's really important for all impact investors. When you set forth based on your values and your strategies, what you're trying to achieve and where, jobs created, sustainable farmers who've accessed capital, schools and educational facilities, as well as affordable housing, any number of measurements that really work with your community. So a bit about our work with faith communities, and then we'll go into a couple quick examples. I'm also I will look to Rachel to let me know how I'm doing on timing. So we've been working with faith investors since the very start, and we're also part now of a larger network of other organizations, both faith asset owners and networks, who are really committed to growing this space. For us, faith investors represent 20% of our assets. These are small congregations, large faith-based mutual funds, and anything in between. We do an investor survey every 2 years and learn that 26% who responded invest because it's aligned with my faith. As Umar demonstrated, communities of faith are rich with ancient and contemporary teachings and practices around money, investing, business practices, justice, and creating a sustainable world. So those are always touchstones for faith investors. We also know, given our work, that faith investors rely heavily on their investment advisors and consultants to guide their strategies. So those are critical gatekeepers in this conversation, and also groups of constituents who need to be educated about impact investing. And almost, I think, to one of the questions in the chat, faith connectors do connect and collaborate, not only within their own faiths, but increasingly across faith communities to try to really build this ecosystem and develop commonalities and places where we can work together and potentially invest together. So we're supporting faith investors wherever they are in their impact investing journeys. And we're doing that at Calvert through conversations like this, through creating resources and to partnering with other folks who want to really see faith investors step up. This collaboration piece is really critical. And I've a number of the organizations that we work with, there are many others. Some are networks, some are particular to specific faith communities, Catholic and Jewish and evangelical, Mennonite, Interfaith Center on Corporate Responsibility for those of you who are interested in faith-driven shareholder activism, which has implications globally. ICCR is an excellent organization. The GIN, which is a secular group, organizes a faith investor hub that I'm a part of, where we're trying to come together and really address some of the needs that faith investors have to engage in this space. So faith investors in action. First case study, or real briefly, is on an excellent group called Faith Invest. They're based out of the UK and work globally. I want to highlight them, again, when you have time, direct you to their site. They're very committed about growing a worldwide movement of faith-consistent investors. They have just created a membership model, and they support their members with a number of working groups that are launching. Any of you who are in the faith community, this is really something worth looking into. They are developing a platform for deals because that's so important across asset classes. Where do we place our money? They, interestingly, are working on a dharmic investing product, and again, communities of specific faiths, Hindu and Sikh and Taoist, to see what that might look like around responsible investing. They also focus on real estate management. We know that faith communities own real estate, hospitals, schools, church buildings, and how do we look at those assets? It's a group that's very committed to also addressing the climate issues and how can faith communities come together, create what they're calling long-term plans to really make deep and lasting impacts in change. An excellent tool that they provide also is these faith, a number of publications on faith-consistent investment guidelines. If your faith institution, whether you be a congregation, a denomination, a faith-inspired foundation, begins to look at impact investing, what is this exactly? What are some universal principles and steps to take? And then what might be specific to your faith? Again, to Umar's example, an Islamic organization looking at doing impact investing, has very specific principles that they need to address, as do most faith traditions. So these are some excellent tools out there as well. And again, Faith Invest is committed to building networks. This is a sample roadmap that a Catholic organization, Catholic Impact Investing Collaborative, puts out. I won't walk through it now, but simple steps to take as a faith community will decide to step into impact investing. Second case study is a group called Mercy Investment Services, a US-based Catholic organization. They are the asset manager for the resources of the Sisters of Mercy, a Catholic order, as well as many of their ministries and partners. Mercy Investment Services has a robust socially responsible investment program. It includes this portfolio screening that we talked about, both avoidance screens based on their values and proactive screens, a shareholder advocacy program where they are actively engaged with other faith colleagues to hold corporations accountable for their behavior, proxy voting, voting the proxies that companies put out every year when you're a shareholder, challenging them to do better. Again, bringing in that environmental, social, and governance piece. And then also impact investing. And they do impact investing through two funds. The Environmental Solutions Fund, which is focused on climate solutions specifically, but the Mercy Partnership Fund, which has been a longtime partner of Calvert and again, a leader in faith-based impact investing in the United States. Couple of examples are up here of some of the places that Mercy Partnership Fund has invested. They are presently invested in, I believe, 65 countries globally. They have as they've gotten more sophisticated in understanding their impact, they actually have an interactive map that you can look at. They've deployed more than $100 million in organizations over the past 25 years. And really see their work as partnership. Partnership is explicitly in their name. I think, again, referring to what Umar talked about, a lot of this work is very relational. It's moving dollars from those who have it into communities who are seeking those dollars. But in order for this really to work, there needs to be this interdependence and relationality. And I think this comes through really clear in how Mercy does its work. They invest in Sun Funder, as do we at Calvert, which is committed to creating clean energy alternatives throughout sub-Saharan Africa. ECLOF International is another faith-driven group that works with micro-enterprises globally. And I just want to pull out Shared Interest, which is they were an early investor in Shared Interest. This is a US-based fund that invests in loan guarantees for businesses originally in South Africa and now throughout Southern Africa. They were started out of the anti-apartheid and divestment movement in the United States in the 70s and 80s, where faith institutions played a critical role. And they continue to invest now throughout Southern Africa. But they're a wonderful example of where activism and faith came together to address, to deal with an untenable situation in South Africa. That had global ramifications, and now have a fund that keeps growing and continues to provide these loan guarantees that invest in small businesses throughout Southern Africa. Mercy Investment Services, as well as Mercy Partnership Fund, again, goes back to some of their what they call critical concerns that drive their investment strategy. I show this as an example because every organization, secular or faith, draws upon their own set of critical concerns. For this community, it's earth, immigration, nonviolence, anti-racism, and equality for women. And they go back to these touchstones, these touch points, whether it be for Mercy Partnership Funds investment strategies, or their shareholder engagement work that they do, or their proactive investing choices with their portfolio. And again, impact measurement is really important for all impact investors and also for faith investors. Mercy Partnership Fund embarked upon a process over several years where they decided what was important to the sisters, what did they want to achieve, and how are they going to measure it. This is just a snapshot from one of their reports. And again, they use the SDGs also to help guide and measure the outcomes of their investments. And then maybe to wrap up a little bit, I just want to give a few snapshots of other faith-based organizations around the US and other ways that they're exploring faith-based impact investing. We know of a Catholic order who actually entered this space relatively recently. In the United States, we often talk about Catholic orders because they've been doing this work for decades. Women religious have been leaders in this impact investing space. They have, over a relatively short period of time, have now invested 100% of their portfolio in mission-aligned investing across asset classes, which includes impact investments, and are now participating in a new faith-based climate solutions fund that the Dominican Sisters created with Morgan Stanley. So that's really exciting to see that come to pass. There's a U.S. denomination that has committed 5% of its endowment into socially responsible investing. And the way that they incentivize their congregations across the states to make impact investing is to offer a match. So that's an exciting program that we had worked on with them years ago, and that's still going strong. And as they decide to increase the percentage from their endowment that goes into SRI and into impact, that continues to grow the space as well. We work with several faith-based mutual funds who are committing a percentage of their assets to impact investing. Some do that through Calvert Impact Capital, some do it in other ways. But again, that's critical for their faith-based clients to know that some of their funds are actually going into real impact. Increasingly in the United States, and we've seen this happen over the past year, given what's gone on in our country, congregations are deciding to bank with their values, whether that be at Black-owned or led financial institutions, community-based banks and credit unions, what we call community development financial institutions in the United States. This is a growing trend and really important to bank locally and bank with values. And to really decide, maybe a corporate large national bank, if its practices doesn't really fit the values that are aligned with my particular faith community. We know of a faith-driven international development organization based in the States that made the decision to divest from fossil fuels recently and decided to take that step further, looking to align their portfolio more with mission and impact, and has sort of taken this on the road. There are a lot of secular and faith organizations who are trying to, want to hear this story and how they're doing it so they could try to do the same. And similarly, faith-inspired private foundations who seek to align their portfolios with mission. And again, as we said earlier, so that the investments they make support their philanthropic goals and don't contradict them and undermine them. So lessons learned, again, for faith investors and other investors as well, really, these are some trends. Faith investors are increasingly responding to the current moment: climate, racial justice, economic crisis, pandemic, locally and globally. Faith investors are revisiting internal financial management practices, whether it be retirement funds and where faith organizations are sending their staff to cash management strategies. Where am I banking? Where's our operating dollars being held? Is that consistent with our values? Again, these locally based financial institutions and others. We know the importance increasingly of engaging in constructive conversations with internal decision makers. A faith community may decide to step into impact investing, but unless your chief investment officer, your investment committee, your treasurer, whatever your governance structure is on board, your outside financial consultants in some cases, you may not get as far as you'd like. So that's another critical group of stakeholders who are part of this. Faith investors are exploring, a range of high-impact investing products, which we've discussed. They're experimenting with carving out portfolio to invest in impact, percentage of assets, these matching programs, and again, the importance and the excitement we're seeing around connecting to larger communities of practice across faith communities. Here's a quick list of some of the resources I mentioned. Again, these are primarily US-based organizations, but could be really helpful. For some US case studies, the book I have up here, Faithful Investing, which came out last year, is really sort of an important resource. And I often talk about Umar's book on Islamic financing, also for folks who are interested. I didn't put it up here, but Umar, I talk a lot about it to folks. So that's another resource for those of you interested in Islamic financing as well. And finally, this is a collective journey. Again, maybe back to that interdependence theme. We want to encourage folks to explore the spectrum of impact investing opportunities across asset classes. Out there are many faith and mission-aligned institutions who really want to do this work, who really want to engage in impact to achieve what we'd like to see change in the world. This collaboration piece is critical within and across faith communities and also with secular communities. What we've seen so often is that in the faith community in the States, folks are very willing to work with each other and learn from each other because this is really in our collective best interests. And finally, to that end, we want to envision a world where we all faith institutions, really all institutional investors, heed the call and lead the way as impact investors to create a more equitable and just and sustainable world for all.
Great. Thank you very much, Amanda, for that insightful presentation. There are a number of questions coming in for you. First question is by Peter, and he is asking why, according to your view, the faith organizations are not stepping into the impact investing space.
I think a lot of it is lack of knowledge. And I just want to say, I apologize because now I see the light in my, I had told Rachel was going to change, and there are lines across my face. Let me take myself off for a moment and see if I can make that adjustment. I apologize. I'm not sure that's much better. I'm sorry about that, everybody. This is what you get when you work from home and not in an office right now. So the question was, why is there reluctance or it hasn't really happened? I think because it's still this is still a new set of investment practices just in the United States. I mean, certainly in the past year and year and a half, we've seen this sort of explosion and interest in impact investing. Again, it's the past year in the States has really, for those who didn't know, unveiled our enormous set of economic inequities, the sort of embedded systemic racism in the U.S. systems, and people are really awakening, and investors are awakening to as well as the climate crisis, to that action needs to be taken and taken quickly. A number of us, as I shared, are working more collaboratively to help build this ecosystem, both U.S.-based faith asset managers and networks, as well as some global colleagues, because it's an urgent situation. So a lot of it's been lack of knowledge, but we hope that will change rapidly. I mean, in many ways, we can't afford it to stay the way that it is.
Yeah, and I think I'm going to link that with another question that has come up, that of limited investment opportunities that match the investor's value. How do we address this challenge, and particularly for the intermediaries that link the investment and the demand side? Do we have to think of how ecosystem support organizations have to develop this kind of expertise?
It's an interesting question. I think groups like Calvert Impact Capital, given that that we pool investments from a range of investors and invest in intermediaries, in some ways that's a source of capital that then some of the smaller institutions don't have to get themselves. Not just saying it's Calvert, there are many other groups out there that are doing similar work. Case about the impact that your work is having on the ground, because that really appeals to all of us. Faith is just another lens by which some of us see the world and approach our investment strategies. So I'm not sure that fully answers the question, but I think it's also connecting with faith institutions in your communities. I mean, if you are part of the ecosystem, what are the churches and the mosques and other houses of worship or faith-led social service organizations who you may not have thought about approaching for partnerships? I think that's something important to think about. Who are stakeholders that you may not have thought might have an interest in your work, who actually do, because we're all really invested in the health of our communities, and may just not know that there are opportunities to move our capital in those directions. And then, of course, it's developing the structures that make it easy. And that's, different, from country to country, the best ways to organize that. That might be a panel for next year.
Okay, great. So these are comments by Joshua. He's keen to connect with faith-based investors, keen on the wash sector. So in case Calvert is looking to invest in wash, and particularly in Kenya, reach out to Joshua. There's also a question on exit options, which are often cited as a big concern. So what has been Calvert Impact Capital experience on this front?
I'll just speak a bit about that. We have a very sophisticated and robust investments team. So they're the ones best to answer that. But we structure deals in ways that allow us to eventually exit. In fact, I think in the next month we'll be sharing on our site some of our case studies of organizations that we've invested in over the years, and for different reasons, have either our capital and the way that it's structured was no longer needed because an organization has evolved, and telling those stories. So that's sort of built into at least how we make our investments, and that depends on the needs of the borrower, and maybe getting back to the relationality. I mean, in some ways, some of the reason why we've had such a strong track record is not only the very serious and rigorous due diligence that we undergo, but it's the relationships that we've had over many years with what we call our portfolio partners, our borrowers. It's really understanding the organization, what their needs are. I mean, sometimes there are hard conversations that have to happen, but this is a partnership. These are partnerships.
Yeah, great, got it. So one last question, and this is around the ESG strategies, the negative screening, norms-based screening. And the question is around how have these strategies adopted by faith-based investors evolved over time?
That's a great question. I'll just share. So this week are the biannual meetings of the Interfaith Center on Corporate Responsibility. This is one of the groups I mentioned. These are in the States, the real leaders in shareholder engagement. These are the stories you hear of nuns, of sisters standing up in corporate meetings, demanding fossil fuel divestment. Over the years, I mean, they make headlines when they do, but they're the unsung heroes, I think, of some of this corporate responsibility and ESG work. Who very early on, and again, as I shared, a lot of it coming out of the anti-apartheid movement, began to challenge companies around their practices, whether it be, environmental degradation and pollution and harming low-income communities or abusive labor practices. So these are some of the groups that have been at this for decades. And I think, as you've seen from some of these, now big statistics in the trillions of dollars, we're seeing an increase in across the board in ESG strategies. And I think we're also discovering very rapidly that from an investor standpoint, business sustainability is much is really linked to ESG factors, that companies that take into account environmental, social, and strong governance practices are actually better investment strategies. So I think we're seeing that flip. It's not just these are good moral things to do, but it's actually better for business and better for value. And Umar, feel free to jump in on any of these questions too, please.
Yeah, I'll open this up for Umar in case he has any more thoughts around what we've discussed about.
I think, Amanda, you've done a wonderful job. Thank you.
Thanks.
Okay, great. So I don't see any more questions. At this juncture, I'd like to just thank everyone. We've ended about 15 minutes early, which I think is a good thing for the folks in our time zone and those in India and Asia. But thank you so much for joining us for the session. I know it's a bit late for some of us, but you still start through the session and just listen to the insights and the experiences shared by our experts. To Umar and Amanda, thank you so much for putting in efforts into preparing the slides and doing the actual presentation. Hope we can get more engagement on faith-based investing. So look forward to more engagement opportunities in the future. Thank you, everyone. The session recording will be uploaded in the next 2 to 3 hours, so you can check on our YouTube channel. Thank you, everyone.
Thank you all very much.
Thank you.
Thank you.
Take care. Have a good day.
Bye-bye.